repeat my question to Bawakar. I was saying that CP raised the question in his response about what's a scalable African tech company. And in Tokumo's response, you mentioned that one of the things we need is more consolidation. So we have very many micro businesses not being, they're not as productive as they could be if they were combined. That raises some tension in my head because at the point where those businesses were being funded, their assumption is that they're going to take over the entire market. So those VC valuations, especially, tend to be very optimistic. When it's time for one company to acquire another, it's often challenging for the founders to then see eye to eye, or the teams to see eye to eye on what the different businesses are worth. And so, Babakar, while reflecting on the past decade in the ecosystem, can you share some thoughts about how we, get past this issue?
Yes, thanks a lot, Osaruman. And I want to thank Tech Cabal, yourself, and Darren also for organizing this very insightful discussion. I think I'll say two things. First, if we look back at some of the data you showed and what we've seen in the ecosystem, I think it was very interesting. You looked at the 2014 data to look at exits. What was the state of exits in 2014 when these companies were founded? We had no VC exits on the continent. And now, as you've showed, we have more than $1 billion in actual cash that has been returned. And in addition to that, several billion in value. And if we look at what the average holding period for a company to get built, like Chirantan has mentioned earlier, I think it would be harsh on the Africa ecosystem to say today that we are not delivering venture type returns. I think one thing we've learned in the past decade is that not only it is possible in Africa to build great businesses within a decade, but that also those businesses can generate venture scale returns and significant impact in terms of job creation, in terms of economic value added on the continent. So for me, the main learning of the past decade is that, and I think we should not just look at cash returns because if you actually let's just look at 2015, 2017. There was around $1 billion, $1.2 billion that was raised back then. Which companies were created in those times, and how much are they worth today? There was MoneyPoint in 2015 that's worth $1 billion. Paystack 2016, 200 million. Flutterwave 2016, 3 billion. Andela 2014, 1.5 billion. OPay 2018, 3 billion, and I can keep going on. There's more than 10 billion in value that has been created from that capital that was invested. So Africa is delivering the returns. The returns are not yet cash, but the value has been created, and it's here on the continent. And so I think that's a very important point, which leads me to the second thing I wanted to say is with regards to exit. Today, we do not have so many M&A and IPOs. But if we look at markets that are more mature, I'm thinking about the US more specifically, 70% of exits happen through M&A. But who acquires those businesses? It's big tech. It's not the most traditional businesses that do the most of the acquisitions. The vast majority is actually done by tech companies. And I would argue that we should focus today on building those businesses to the scale where they will be the acquirers, rather than focusing on the short-term acquisitions, because that's how we will drive long-term value for the investors in those businesses and for the economy. And that's how we will build those businesses that become the platforms to acquire tomorrow's businesses and create, the virtuous cycle of innovation, growth, and acquisition. So for me, the solution is in the future, but it's also in focusing on businesses that are fundamentally good companies, because we have had this bubble, which during a couple of years, and there were big arguments in the industry, and I won't name names, but some people were that convinced that GMV was a very good way of valuing companies. You know, I come from the corporate space before and private equity. You have to think about who's your buyer in the end. Investing is about paying, creating value, and then selling. If you're exiting to investors an African business, you're likely going to be valued somewhere between 5 to 8 times EBITDA. So what really matters is building businesses that have very strong fundamentals. Now, there are the financial fundamentals and the non-financial. The financial fundamentals is EBITDA and cash flow and growth. That's what matters. And then the non-financial fundamentals are governance, is around the quality of your teams, the quality of your process and operations. And very importantly, a topic that I think would deserve more attention is building a coherent equity story. Some businesses now, we're hearing a lot these days, oh, Africa to LATAM, Africa to Asia. I'm like, okay, sure. This is top line, maybe bottom line. But, what is this business about? What are the synergies between having your business, I don't know, in Tanzania and Mexico? Like, is that something that creates more value, or is just a very opportunistic move that doesn't have synergies in the business, and then makes it really hard to either IPO or do an M&A? And so, yeah, so I will stop there, but I think for me, that's what we should really be focused on, creating value. And as a result, that means the exits in the foreseeable short to medium term future are going to come more from secondaries. And if we just look at transactions above $25 million since 2019, we have had 125 such transactions, which generally include a portion of secondaries. I've seen anywhere from 10% to 50%, and in one case, 100% of secondaries, which has been counted in capital raised, which it is not. And that's about 8 billion in deals. If you take 10 to 50% in secondaries, that's $1 billion to 4 billion of capital that has been returned potentially. And so I think that's where we should focus our energy and building good businesses.
Can I?
Yes.
So I agree with Babacar about the focus on secondaries. I agree about the focus on value creation and not cash per se. And these are arguments that actually I talk about to a number of people, including some investors. The fact of the matter is, for us to get cash coming into the continent and into the key countries, we need to show liquidity. We need to show cash. That's what people. If you're fundraising at the moment as an investor, let's put aside as a tech company or a VC play. Everyone wants to see the cash that you have returned. And so, yes, indeed, secondaries can play a role there. But what you're also finding is that with some of those secondary opportunities, I mean, Moneypoint was great because lots of secondaries came in and took out some of the primary, the initial investors, not all of their money. So those that had some of a return, that's great. It shows something. But the investors in the funds want to see their cash returned. There's a focus on DPI, and you can't get to DPI unless you return cash. So I think secondaries are great if they can provide that. What you find is that there's a lot of choke on secondaries, where the secondary will say, yeah, okay, maybe I'll take 10%. Where the next investor coming on will say, maybe I'll take 10%. And that is not enough cash for the fund manager who's trying to get cash back. So we need to, it's one of the levers that we need to pull alongside the others that I mentioned, deepening the stock markets, roll-ups, consolidations. And roll-ups not just because, we need to just create these bigger and bigger platforms, but also roll-ups for efficiencies, because we have lots of small businesses that are replicating some efforts, and actually they can come together and build bigger platforms. So I agree with you. I think that then secondaries is one of them. The other is maybe even with the redeemable instruments. But the key thing is that it as you've mentioned, VC private equity, it's a value chain, it's a food chain, and everybody needs to pay the next person up. And so yeah, we need that liquidity to happen through value creation and also cash.
Thank you so much, Tokunbo. You preempted my comment and question. for Babacar, but I think it's a great place to pivot to CP. So one of the implications of focusing on long-term value creation is that maybe VC funds, we should assume that their life cycles are going to be longer. CP, how do you feel about that as an LP?
I think no, this is a very, very interesting point, and I think patience in this asset class is actually by design, and I think a lot of people kind of don't appreciate that, and I'm also conscious that most institutions that are investing in it all come from a very different kind of context, right? Because a large part of dollars and commitments of LPs are either in private equity funds, infrastructure funds, which generally are shorter in terms of their cycle. If you look at data, even globally, and I'm talking top decile VC funds, they take 15 years to return, right? Like 8 to 12 is just not happening. So, but I know that's what it says on the tin, but it's not going to happen, right? But does that mean we just keep pushing it and saying no, we need to think about it? No, I think there's a discipline aspect to this as whole point. So I think it's baked in, but patience does kind of run thin when LP is going to start to have this whole build-up of commitments for quite a few vintages, and still nothing is moving. So we can't. There needs to be a point of saying, okay, we've done one fund, we've done second. Where are things moving? And that question will come up the next time we do it. I think the one good way to think about it is if you're a recurring LP in a fund, the way to think about if you're in fund 3, for example, like, can I actually sell fund 1 as a secondary? Can I price it? And that should give you a good understanding of track record, and it's a much more real argument. So secondaries is a way. We've kind of attempted that across this asset class, both in Asia and in Africa. That is a way to kind of drive returns, but also a way to mobilize capital for people who want it. But I just want to caveat one thing. Secondaries, even globally, is probably only 10% of the total primary dry powder raised for investment into VCs. So it's not a full takeout mechanism. And the other thing to understand about secondaries as a product is that the reason it's liked because it contains de-risked assets, right? It can, you're well beyond your J curve. And so we should not kind of go in thinking, seed fund, even early stage, that things are de-risked and we can, pass it on as a secondary, because there's still a lot to do in them. But I think Tokunbo raised a very, very interesting point that the private equity SME segment also has to develop. And I think the way I think about it is there's this whole conveyor belt of capital, which in some markets is perfectly there. So you have angels, incubators, VC funds, private equity, et cetera, and growth buyout. So everyone kind of picks up from somewhere. I think we're missing something here. So we have a very, very vibrant VC ecosystem in Africa. Some of the smartest people running great firms, great founders. And VCs, the way we look at an early stage fund is that you just need to back good companies. Founders will figure it out. Sure, you can add a bit of value, but that's not really your role. The real role of a private equity investor is to focus on some of the hard stuff, some of the more mundane kind of aspects around growth, etc. That's missing. And I think we need to be conscious as funders of this ecosystem to also continue to back this, because I don't think one should expect VC to carry the whole burden of what we need to do tech in Africa, right? It needs to be taken up by large private equity groups as well. So again, what I wanted to also repeat is that yes, exits are not there, but it takes time. But also we can't just be putting all the attention on let's say Babacar's here as a GP, so you shouldn't be carrying all the weight on your shoulders.
Thank you so much, CP. One of the key parts of this value chain or this food chain is large, perhaps technology forward or technology enabled companies acquiring smaller ones. Something that's been surprising, reflecting on the past decade in African tech, is that African, but let me specifically say Nigerian, big banks, for example, are not very acquisitive. I would have expected, for example, a business of the size of an Access Bank or an FCMB to be acquiring, even if it's $1 million valued startups, to plug specific, I guess, gaps in their product suite or in their business. But we see that they often prefer to try to build it themselves. So Tokunbo, I'm curious, one, why do you think this is happening? And two, again, how do we fix the conveyor belt?
Yeah, well, why is it happening? The fact is, the banks feel that they have, the banks have the deep pockets and feel that they have the technical know-how to build out. I sit on the board of one of the banks that you mentioned, and when you survey what's out there and you look at the price that the owner of a tech might be thinking of, then you think, well, actually, I may need to build this myself, but I also may need to build it myself because I have a unique tech infrastructure that platform may not have been built for. But if I look at it from the other side of the, let's call them the Davids, so David and Goliath, the Davids, do you really want to be bought so early on, 1 million valuation, and then have your innovation stifled? So I'm not necessarily a proponent of buying so early from such a large bank, but maybe there's a larger similar tech platform that you can roll up with and consolidate. That's where I feel some roll up can happen, and you can get economies of scale, efficiencies, and talent. And you're not reliant on the one single founder. Where you can build proper teams. So why isn't it happening from the bank side? I mean, there are a myriad of factors. Some of that being some of the technology isn't sufficiently baked, or some of it is overvalued before it can come in.
Thank you so much. My bosses at TechAbal have informed me that I guess we need to pay attention to the clock. And so I have one final question before we move on to the presentation about the TechAbal Insights Exit Dashboard. So when we look at the companies that were, or the capital that came in between 2018 and 2023, a significant chunk of that capital went to 100 million plus growth stage rounds. And a lot of this conversation is actually about what's going to happen with that capital specifically. If those companies were to try to list on international markets, they would need to have business models that are familiar, at least based on what we've seen so far. They would also be considered small cap companies because of their current size. But as we've said in this conversation, local markets are maybe a little bit too shallow and are not fit for purpose for those businesses. Babacar, do you have any reflections to share on, just as we wrap up, on what would happen with those businesses specifically, or what interventions need to be built for scale-ups currently who have taken in growth stage rounds to see exits in the coming years?
Yeah, now that's I feel the weight on the shoulders.
Okay, we can hear it.
I think it's an important question. Earlier in the discussion, I think Darren mentioned how some companies' valuations, are maybe still valid or maybe not valid. And the question is, what do you do with that capital? The capital efficiency is one of the key features that we look for in startups that we back. And capital efficiency is about how much value does the capital you put in generate post the investment. And I think that's the first thing that those businesses need to focus on, because if you raised $100-200 million at $1 billion valuation, investors are looking for a multiple of that in terms of value creation. So you should be looking at $3-4 billion in valuation down the road, which at that scale becomes much harder to generate because it may mean entering new markets, entering new product verticals. And it's a story about continuing to create value beyond that $1 billion. And I think at where those companies are today. Many of them are single country fintechs. So it's about entering new markets with different regulation, different setup. If we think about, whether merchant payments or mobile money, is it bank led or is it telco led markets? So it's not the same type of competition. And so it's extremely difficult decisions that have to be taken. And as CP mentioned, that's where private equity and strategics can provide the value. And so it's really important for those businesses to have the right kind of shareholders and partnerships in order to be able to deliver that value. So I'd say that's the first thing. And second, equity story becomes all the more important, and hitting the right metrics. When you're thinking about exit on an exchange, at that stage, different, like currently it's going to be London or the US or dual listing in Africa. You need to hit $500 million revenue, $200 million revenue, a certain growth rate. You will get benchmarked globally, and you will get severely discounted as an African business. The multiples you can fetch for similar numbers between an African and a US business are just not comparable. If we think about CloudStream, which is currently doing its IPO, they're doing 1.9 billion in revenue and raising at a $30 billion valuation. That's not applicable to African startups. And so that's why also the valuation of those growth rounds need to make sense, because exits will be challenging. So for me, that's the two things I'd focus on: the equity story, the key metrics, and making sure the business remains very capital efficient.
Thank you so much, Babacar. That's definitely reflected in the research that Darren and I did of the companies of the exits that we showed. All of those companies were acquired for less than $1 billion, and I believe, with the exception of InstaDeep, they all raised less than $800 million. Tokunbo, do you have any reflections to share as we close out on, I guess, how we can engineer success or exits for those companies?
I mean, I think we've touched upon many factors. We started with talking about broadening and deepening the capital markets to be more accessible for the smaller companies. There's a whole discussion that can be had about that. But even within that, we've spoken about from creating value within the companies, from thinking about innovative forms of getting liquidity for the companies. Secondaries, we've already spoken about that. It's one form. So for me, it's we have a toolbox, and we need to pick on different tools within the box. And I think that overarching it is, as we think about how we make the environment a better business environment, and we think about our local capital markets, and we think about our local fund managers, we need to see more domestic capital from big asset allocators, because that brings more cash into the market, that brings more cash that can go into the funds that make investments, that brings more cash that helps the ecosystem thrive, that brings more interest from the advisors, the bankers, the lawyers, because we need all hands on deck, and we need the different parts to play. But a big missing part is domestic capital, because much of what holds us back as a fund manager, for example, when you're looking at the valuation to think about, can you sell now, can you not, as the company grown enough, you're also looking at that in terms of whether it's local currency returns versus US dollar returns. And the local currency returns invariably is usually significantly higher. And then you're thinking, well, I need to hold a bit more because the USD return isn't quite there. If we had more depth in our local capital with the domestic capital, that could help release the strain, some of the strain at least.
Thank you so much, Tokunbo. CP, any final words?
No, I think we're obviously long-term investors in the region. Really understand the opportunity there. I think the interesting side that we get to also see is we talk a lot about private capital mobilization and PII. So how do we get people from the US, people from other markets in? And it's very interesting. What do you what do you sell them? Do you sell the region? Like, do you sell, let's say, Nigeria? Look at Nigeria; it's such a vibrant market, or Egypt or South Africa, or do you sell the company, which is fast growing? And that always is a very, very interesting dynamic, especially as companies look to exits, whether for IPOs outside or with a global buyer. So I think nailing that, which is, it's actually a great company growing really, really fast despite the macro. Don't worry about all that. That's quite important. I just wanted to mention, there was a company which recently listed in NASDAQ called Kaspi. It's a large company from Kazakhstan. It's a small market, but raised $1 billion. It is just playing on that. It's not playing on some kind of regional expansion. So, and there are kind of lots of other aspects to learn from such stories out there. So I think, long-term positive, but it's our job always to keep this momentum going in the ecosystem. So yeah, long-term optimists here.
Thank you so much, CP, and thank you to all of the brilliant panelists, I guess, who have made this an amazing conversation. We've heard we need patience. We need to focus on the fundamentals. We need to fix the conveyor belt, if I can put it that way. We're going to transition now quickly to the TC team. They'll give a short presentation about their exits dashboard, after which we'll come back for audience Q&A. Thank you so much, everyone. TC.
Hello, everyone. Can you hear me? Yes, so I will just be doing a brief presentation of the startup acquisition dashboard. So we've been collecting data around startup acquisitions in Africa over the past 3 years or so, and I'll be doing a brief demonstration of the dashboard. So essentially, this gives details of acquisitions that have happened in the ecosystem, startups that have been acquired, the acquirer across the country, different sectors. So for instance, if I select fintech, we can see the number of acquisitions that have happened in the fintech ecosystem. We can also find a breakdown of the details of the acquisition and a link to read more about it, right? So I believe Victoria would share the link to whoever is interested in this, so that you can have a walk through it yourself. Yeah. Over to you. Thank you.
Thank you so much, Margaret. Just a quick change to the agenda. I'll be running the questions. It's a small technical issue, but it's okay. You are in good hands. There's a couple great questions already to dive into. The first one is, thinking out loud here, if we advocate for local capital involvement, valuation naturally becomes a key consideration. There have been numerous anecdotal concerns from local investors about whether startup valuations are fair for their participation. Additionally, there are concerns about potential challenges if listing on public markets isn't viable across various African countries. I think we have already covered this. Up next, what barriers to security exchanges, e.g. NGX, remove to accommodate VC-backed companies? I believe Tokunbo spoke specifically to this as well. But Tokunbo, do you mind giving us some additional color? I'd love to make a list, and maybe we can publish something about it later on specific interventions by the NGX.
I mean, I think I've mentioned most of them. Simplifying the listing requirements. For an introduction on, say, the NGX, it doesn't need to be the same as the main capital markets. And if you're trying to drive for innovation, you can think about how you simplify things like the ratings, the collateral. There could be financial incentives as well to some of the smaller companies. We have more companies that could list in on the exchanges, probably from the real sector. They shy away. Maybe they need some more incentives to get the markets a bit more vibrant. We could educate both listers and the general populace about engaging with the capital markets. We can improve access to the capital markets, like I mentioned, with the domestic capital. If we see more domestic capital coming into the exchanges around the introductory side, we can see more happen. Again, with technology, we're talking, maybe there's a VC play that comes out of this. We need to see more technology use across the exchanges that makes it possible to actually reduce the cost for some of these smaller entities. We need regulation that supports that, and maybe even have some sector-specific entities or vehicles where we can see some consolidation. So all in all, we need to strengthen lister confidence, investor confidence, general market confidence. We need to deepen the markets. But that also goes hand in hand with everything we've said earlier. And I just have one last point actually relating to what CP said about a company in India. Well, I mean, India is the whole of Africa. So, and we don't have one exchange. So maybe if we had one exchange, you can talk about, size of capital markets, size of population. So our companies do have to think about regional expansions because they don't have the one country, one language, one currency, one stable currency. And so while I like that analogy for a company that needs to focus on fundamentals, and all companies have to focus on fundamentals, the context in Africa with our fragmented nature requires some innovation to solve for our peculiar challenges.
If I may,
Thank you so much.
bounce on that answer. One thing we noticed last year was there was a very strong, correlation or link between the increase in stock price and the exposure to Francophone region in particular, but generally to rest of Africa in Nigerian companies. And I believe one thing that has not been done yet in the African tech ecosystem is building true regional players. And I'm thinking especially across West Africa, where we have very strong pre-existing economic links. We have not yet seen startups from Nigeria enter Francophone, startups from Francophone enter or partner with Nigerian startups. And I think there's a lot of value that can be unlocked there because that will significantly de-risk the macroeconomic profile of those businesses and make them more attractive, not only to local, but also to global investors, because they will be more resilient.
Indeed.
And that's one thing, at least we're exploring on our side, but I think the market generally should dig deeper into.
Indeed.
Do you think the biggest barriers to this happening are currently political, cultural, or something else?
They're not.
I think. Sorry, go on.
No, go ahead, Tokunbo.
No, I was going to say it needs another podcast. It's going to take a whole hour on this topic alone. But please go ahead, Babacar.
I was going to say I don't think it's political. I think there's some cultural aspect to it, but that can be overcome. I have an icebreaker that's about jollof rice and chep, which I've developed over years. I'm sure other people can find other things to connect across the region. No, I think more seriously, it's also about knowledge, know-how. Fintech is what has scaled so far. If you want to enter the WAEMU region, you speak to the WAEMU central bank. You need to speak French. You need to engage with the highest level stakeholders. You need to engage with ministers. You need to engage with regulators. Your teams need to be carefully selected. And it's not straightforward. There's no playbook as of today. The ones that have done it successfully are the banks, especially players like UBA, that have been, very forthcoming in that space. But it's a very long-term engagement, and you have to make it a priority. And until now, what I have seen is, which I think is not the best value creation, at least, is going like Nigerian startups or Kenyan startups going, to each other's market, where the linkage is much less obvious. It's not the same region. We saw what happened when Nigerian fintechs went to Kenya. They were not helped. And so I think actually focusing on markets that are closer geographically can be an edge, but you need a partner to do that. You can't do it alone.
Thank you so much, Babakar. Reflecting on, the past decade of the ecosystem, something that kept coming up for Darren and I is that the capital that came in invested in infrastructure that should enable the next, I guess, wave of outcomes. The story that, lots of us used to think about the opportunity on the continent in the past decade involved population growth, involved rapid urbanization, involved smartphone penetration. I think it's probably safe to say on this call that we can put that story to rest. Let me know if you disagree. But one thing we're really curious about is, well, where do you have conviction today? Why do you believe that we will build much more valuable ventures in 10 years than we're building today? And what are you underwriting? If we could start with CP.
No, thank you. I think I think what we are underwriting is that you will tend to have quite a few moats, surprisingly. And if you listen to something like what Ifosa Ojomo, who's a very well-known writer and kind of observer, he says that in Africa you don't just build the company, right? You also have to build the road and buildings around the company to reach that business. So when you start to do that, you start to build the entire infrastructure around it, and that becomes quite valuable. This is not the same in other markets, and I think that's a very, very important distinction here, because in other markets it's very easy to replicate, and we're seeing that in, if you look at the US, kind of whether it's AI or software, it's easy. It's like, you can just start something there, but to build something substantial takes you tend to build a moat. And I think people who identify that right up front, the fintechs have done it, some of the successful names, you'll start to see a lot of mobility companies doing it. E-commerce in some ways did it for a while. So, you'll start to build very, very substantial moats. And I think that's the strength of most of the founders that we see. It's a very build from the ground up. We see that in other markets as well, other emerging markets. So that's why we're excited. I think earlier we used to think this whole thing about expansion, and expansion keeps getting brought up. It's not as natural, I think, as Babakar also mentioned. It's not as natural, and maybe that's fine, because even if you look at take Europe, for example, it's not a single market. They're very, very different kind of cliques and differences, and it's just that those individual markets are large in itself. And so people building these regional champions actually could be quite interesting. That's what we're excited about. That's what we get excited about when we back on the fund side, backing kind of local managers who are very, very focused on particular kind of aspects, but also then companies who may want to expand but are extremely well penetrated in that particular market. We think they have a right to win, and I think that's kind of played out.
You suffer for 8 years and then get the right to be a monopoly. In summary, Takuma, do you have any reflections?
I mean, if I want to come in on that, when you think about, and indeed all our companies, you have to backward integrate, build that infrastructure, and then half your money's gone, and then you haven't quite reached where you need to scale to, and then we're asking them for liquidity. So we need actually also the governments to step in and build the right infrastructure and put in the right infrastructure that makes ease of doing business better. So yeah, you can build all of that, But again, for me, all hands on deck. You need to come together. For us, we also focus on the markets and the essential goods and services. It's a key part of what we do, because then we know that we're not just focusing on addressing the 1% of the market, but we're addressing a larger market when we think about ordinary things. So we're not just in tech, we think about food, ordinary food and beverage that the masses require. Financial services is a key part of what we do, leveraging technology in that, leveraging efficiencies and economies in scale in manufacturing and agribusiness. That's very important to us. Looking at share of wallet for essential goods. So whether that's health, education, and the financial services. So for us, those are areas where we feel that if you're building products and services in non-discretionary aspects of the wallet, you can also build a kind of moat around you or unique selling proposition to scale.
Thank you so much, Tokunbo. Babacar?
Yes. It's an interesting question, because also you're asking for the next decade, and the word keeps moving. I could tell you stablecoin, but I don't know if it's still going to be around in 5 years. So for us, we try to focus on two things. First, of course, is the founders, and maybe because we're earlier stage focused, we're really focused on founders that understand deeply the problems and that are really committed to solving those problems, because the how is going to change. And if you look at the companies that have scaled, they have already internally pivoted kind of the operating model, moving from cash in to cash out to actual merchant payments, etc. And so you need to have that team that's really committed over the long term, because at Askia's level, we're focused on companies that can become those big techs that I mentioned earlier. So that means this is not a quick flip. It's not going to happen over 5 years. So the selection of the founder is actually the most important, because the right founders will have not only the good fit with the problem that they're working with, but they also will be able to scale with the companies. We have seen several instances where at one point the cap to the potential of the company becomes the founder. And when the founder is still a significant shareholder, how do you scale that business? Because we have not yet reached the stage where people put company before themselves in the ecosystem, at least. And one other capability that we see extremely valuable in Africa is founders that are able to inspire and partner up. Inspire, because you need to be able to attract talent in a market where talent is expensive and scarce. And partner up, because very few companies can operate in a silo in Africa. We don't have, SaaS businesses that can sit in their office, do online ads and disappear. You actually have to work with a wide range of ecosystem, including government, like Tokunbo mentioned, and the ability to build those partnerships in innovative ways and solve problems, not just by paying money, but by being creative and aligning incentives between you, your sales force, your partners, etc., is a key driver of value. So those are the first things that we underwrite, and we keep underwriting. On like the business model side and the kind of thesis side, we look at companies that drive digitization or leverage AI to boost productivity. The core theme for us is productivity, because if you're driving productivity for your customers, you're increasing revenue or decreasing costs. You have extremely strong stickiness in your business, and you're also driving value creation. So it's a self-reinforcing process. We don't invest in the theme of Africa's emerging middle class, because we think you have to first produce to make people wealthier to actually generate that middle class. There has been a lot of debate on that middle class. We think consumerism is not the key theme today, but we can get there if we create more wealth. And more specifically, what are the models under that we look at? We like hybrid models, which can come in different forms. It can come with agent-backed models that support the digitization to connect, whether it is to farmers or to small businesses or to people. It's also models like in EdTech, where you can have physical and digital training, because it reduces the cost and effectively increases the access. A second theme which is related to AI and AI potential companies. We're looking at companies that generate vast amount of proprietary data. Because going forward, this is where the value is going to be increasingly. OpenAI cannot compete with you if you have exclusive access to all the healthcare records of Nigeria. They cannot have a better model than yours. And that's a case where we can actually build AI on the continent. Now, that includes companies that are already doing things in the healthcare space or could be AI native companies. But we think digitization and that data generation are the two key things. And that's how we can drive, value creation.
Thank you so much, Babacar. I want to pause here. Darren, do you have any reflections to share? We're going to wrap up soon. We're running out of time.
Yeah, no, I think this has been a really interesting conversation. I think I love the long-term perspective. Our view, Osaramen and I, is one, we always want to take the long term, but we don't want to use that as an excuse. And so when we think of 15-year venture cycles, we can't sit on our hands for 15 years and then at year 15 look back and say, well, what happened, right? And so we love to look at what are the signs that point to where we're going, whether we're on track or off track, and what are the adjustments that we need to make if we're on track to go off. And I think lots of food for thought in this conversation. So really glad we've had it. Looking forward to going out for coffee with everyone on this panel at some point and even deeper on these topics. But this has been really fun to listen to. So thank you all.
Thank you.
Big thank you to everyone for taking the time to join. We've come to the end of the session now. Just a quick reminder to the audience, please fill out the post-event survey and take a look at the TechAbal Insights exits dashboard. This conversation was produced by TechAbal Insights in partnership with the Subtext and Unevenly Distributed. Have a good day.
Thank you. Cheers. Bye.
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 Thank you.
Thank you.
Bye.